Alright guys, so let's talk about the main event today, and that's the US-China trade war. Now this underpins everything, and the closer we get to resolution, the better it is for the global economy. Now remember, it was Bessent who chased down the Chinese. He ran all the way to Switzerland to meet the Chinese trade delegation and went home with a deal. US tariffs on China were dialed back down to 30%, and Chinese tariffs went from triple digits to just 10%. Now, we know the US has a floor of 10%, and that's what China ultimately wants. But Bessent is asking for the moon. He wants China to stop subsidizing their industries and not to manage their currency, and both of which will never happen. Imagine Beijing telling the Federal Reserve not to cut or hike interest rates. It just won't happen. And in the meantime, the US is still imposing export bans on China. And this time they are targeting chip design software and all the chemicals needed for Chinese industry. And let's not forget Rubio also telling the world that Chinese student visas are in danger. They are about to be revoked. So if you're Beijing, do you want to proceed ahead with the trade talks? Of course not. You just sit back and twiddle your thumbs because the trade war is already damaging the US economy. And Bessent has admitted that things are in a downward spiral. He called the trade talks a bit stalled, but here's the real red flag. He admits that the two heads of state, Trump and Xi, needs to call each other to work out a deal. But that's going to be a fantasy. China knows the game plan is to wait out the US. The economy is on the brink, and sooner or later Trump is going to cave again. And on Trump's end, he still believes he's winning. He can't give up the tough guy persona, and it seems things are going to escalate once again. Horrible news for the markets and the economy in general. And here's what Trump wrote on Truth Social. It tells us that the justification has already been written. We went in effect cold turkey with China. It was devastating for them. Many factories closed, and there was, to put it mildly, civil unrest. So according to Trump, China was on the brink of collapse, and he's the savior of Beijing, which is really bizarre. I made a fast deal with China in order to save them from what I thought was going to be a very bad situation. Then after that, he blamed China for violating the agreement. But here's the thing, what agreement is he talking about? Did China impose more tariffs on the US behind their back? Is this related to the Phase 1 deal years back? We need at least an idea of what's really going on here. So it's time to brace for impact. Trump is so mercurial in the next 24 hours. It's not impossible he just comes out and undoes the tariffs. And if that happens, we can expect a wipeout in the markets. Everything will crash again. There's a very funny Wall Street trade going on, and it's called the taco trade, and it's driving Trump up the wall. It's wild, but it makes sense, and it's a big reason why China is simply just gonna wait. Basically, it stands for Trump always chickens out, and traders are using it as their new strategy, the playbook in 2025. Every time Donald Trump makes a tariff threat, the markets will fall. Traders then buy in and make a pile of money because equities rise. Ultimately, thanks to Trump caving, Trump will U-turn. It happened during the Chinese tariffs, the auto tariffs, and the 50% trade on Europe and all the reciprocal tariffs. So there is a strong precedent set. The first rule of Fight Club is you do not talk about Fight Club, right? Well, Wall Street just gave up the game. And now that the cat is out of the bag, we must expect the unthinkable now. Trump might just ramp up the tariffs to prove a point to protect his ego, but there will be repercussions. And can the US markets endure a further meltdown in a trade war? Firstly, US goods imports fell by the most on record in April. It collapsed by nearly 20% month on month. And this shows us how brutal the Liberation Day tariffs were. On one hand, you can call this a victory. The trade deficit has narrowed by a lot. But there are also two problems with this. US consumers are now paying higher prices for their products, or they are buying less and using their stockpiles that they got in March and February. This also means US trade with the world has slowed down and global exporters are facing a revenue collapse. So the flow of dollars has also dried up. Remember what we said before, US trade deficits are a big factor for US capital surplus. And if Trump ramps up the tariffs again to spite China, we will see part 2 of the US consumer collapse. Not good for an economy that's driven by 70% domestic consumption. US consumer spending growth is starting to slow. Growth in April came in at only 0.1% versus 0.7% a month earlier before the Liberation Day tariffs. People were rushing to spend in March and they almost stopped in April. Now, before you think that's impossible, the US is now accusing China of violating the recent trade agreement signed in Geneva, and it's really important we mention this. It's a sign that Chinese supply chains is the real worry for the Trump administration, something that the US hasn't built out over the decades. Now, the US Trade Office is scolding China for not approving their exports of rare earths to the US. Why? Because it hurts US industries, especially those making AI chips. Apparently, China is just too slow to roll out those export licenses. But shouldn't it be obvious? China wants to see a rollback of the semiconductor chip war as well, at least not an escalation of it. So we are headed back towards a tit for tat strategy. But is this enough for the US to ramp up the trade war again? Maybe it is, but a deeper concern is the trade deficit and how the US is dead set on reducing it.
The reality is the trade deficit has exploded by 40% over the past 4 years. It was $850 billion around the beginning of the Biden administration, ended at $1.2 trillion. So that's extreme by any measure. It's one thing to have a deficit or surplus that fluctuates over time, but to have it increase so substantially in such a short time and be accompanied, by a worsening in our net international investment position, where we're at negative 26 trillion at the end of last year. I mean, this is crazy stuff where the foreign firms and individuals have claims on U.S. assets in a way they've never had it before, and that's a dangerous situation.
Now, once again, we are back to the good old trade deficit argument. The world is not screwing the US. They are giving real goods in exchange for paper dollars. And some people would argue it's the US that's taking advantage of the world. Countries holding US assets like bonds aren't some nefarious scheme. In fact, exporters are vendor financing the US economy, giving them the money to run the country and to keep buying products. And if exporters, if countries didn't do this, there would be a bond crisis. And beyond just US treasuries, the dollar itself is in a very serious situation. This will put more pressure on all US asset holdings. The US dollar might be set for weekly gain, but the bigger picture is still dire. It's very horrific. We are still set for the fifth consecutive monthly drop on the dollar strength. The decline started in January and cratered in April. And should Trump ramp up the pain in retaliation to China or the Teco command, we could see the dollar collapse again in June. Now, investors all over the world, they invest in the US because it's supposed to be the gold standard destination. Asset prices are supposed to climb forever, isn't it? The dollar strength is also expected to be stable and not suddenly collapse. But the trade war is unraveling this narrative fast, and we cannot underestimate how much money, how much holdings foreigners have in American assets. And these are just the numbers from Asia alone. Collectively, they hold at least $7.5 trillion, which shouldn't be a surprise. These are some of America's biggest exporters, and they stockpile a lot of dollars from US consumers. And because the US doesn't export much themselves, these countries recycle their trade surplus back into US stocks and bonds. And that's why the last 20 years was more or less an incredible bull market for the S&P. The index beat every other market in the world. And that's how the idea of the US being exceptional really came about. But if the US goes pedal to the metal, this entire flow of capital might stop. Not only stop, it could even reverse, especially if the economy falls into a recession. It's not hard to understand. Countries have fewer dollars and US growth is now in question. The perfect recipe not to invest. Now, Bessent himself is getting rather desperate for China to come to the table, but you realize that he's making a big assumption that might not come true.
This is going to require both leaders to weigh in with each other. They have a very good relationship, and I am confident that the Chinese will come to the table when President Trump makes his preferences known.
It's a very dangerous assumption that China will cave to Trump's demands. We have seen no evidence of that happening. Even Japan isn't caving yet, and their dependency is through the roof. Another issue to consider is the risk that is happening to US bond values. Now, yields have been bouncing around 5% for the 30-year and 4.5% for the 10-year. But in totality, holders have lost money in May. US Treasuries are set to post their first monthly loss this year of 1.2%. And this fall is across all maturities, showing how much of a bloodbath May was. If an inflation continues to stay at 2.3%, there's still a big gap present. The problem with higher rates gets magnified when we zoom out. This is where holders of US debt has really been royally screwed. US bonds have gone literally nowhere. In fact, you would have lost money. Now, since 2020, thanks to the rate hikes, bondholders would have lost at least 7% if they bought US debt, and this includes the coupons or interest payments. How is this a good deal when real assets like gold keeps climbing higher? It's a big reason why we keep saying bondholders have been screwed for many years and might be screwed for the years to come. And if the big beautiful bill passes, we could see an additional $300 billion in deficit spending hit the economy. Bessent would have to issue a tsunami of bonds when everyone and their mother they are afraid to buy them. And you would think that maybe now is the best time to treat foreign holders well. You need your money, right, to keep yields under control. But inside the big beautiful bill itself is a Trojan horse. Now there's something called the Section 899 that threatens to get companies to leave and investors to dump even more of their holdings. Now it's called the Enforcement of Remedies Against Unfair Foreign Taxes. So individuals and companies from countries could face tax increases if their home country has tax policies that Trump finds discriminatory. Now, do you know how crazy that sounds? This is so broad and so non-specific that they can really hold foreign capital locked in the country. It's a type of capital control or even capital confiscation, depending on how you see it. Do you think that is going to entice countries to reshore their industries to the US? How about investors? Does this look like the ultimate blueprint for a booming economy? Doesn't seem like it. Sounds like the exact opposite. So the US is really playing with fire here. And let's realize how precarious the situation is for them. They simply cannot afford for treasury buyers, especially foreigners, to walk away. This could make the coming recession even worse. Right now, bond yields are dropping because of economic weakness. Some buyers are emerging to hedge themselves in case of a collapse. But if foreigners walk away, we could be in a recession where yields keep rising because supply outstrips demand. Investors would be worried about whether the economy can truly recover or not. Now, the US is sitting on a mountain of problems, and a really big one is the losses US banks face. Now, as we speak, Q1 losses are sitting at $413 billion. That's a lot of money, and this just reeks of the SVB like crisis brewing. If foreigners walk away from US bond auctions, local buyers like banks will have to step in to fill the gap. Should yields continue to drive higher, their losses will compound. Even if the banks don't collapse, it's still a very big problem. They can't realize the losses and take a write down, but yet Scott Bessent wants them to buy more bonds. And that's why he wants to deregulate Wall Street in the first place. So now even more liquidity dries up. Your money will be going to the US government and not Main Street. The domino effect here is very, very real. Is there reverse gear? I can't see any, guys, but if I was the White House, I better find an off ramp and find it fast. If the first inning was this bad, the second chapter will look even worse. But let me know what you think. Will the US ramp up the trade war with China? And is there even an off ramp left in Washington today? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.